When you allow customers to purchase goods on credit, or even if you do work for them on credit, you're taking a chance that you won't get paid. These accounts are called bad debts. In my on-campus classes, I usually sing at this point, so aren't you glad you're not taking this on campus? Bad debts are technically called uncollectible accounts, and it's a rare business that doesn't have some. There are two ways for a business to account for these bad debts, the direct write-off method and the allowance method. Let's look at the direct write-off method first. Using the direct write-off method, the company determines that J. Kent is not going to pay off his or her debt to the company. Rather than let that account remain on the books and on the balance sheet, the company makes a journal entry and removes it from accounts receivable and also records an expense, bad debts expense. This entry allows the company to remove this account from net income as well. Note that the customer is specified in this entry. This creates a record of the fact that J. Kent didn't pay and should not be given credit in the future. But there's always the chance that J. Kent will feel bad and will come in at some point and pay off the debt. If that happens, these journal entries have to be made. Reverse the entry that wrote off the debt and record the payment of the account. Again, this creates a record of J. Kent coming back in and paying the debt, so in the future, should credit be asked for, it might be granted to this customer. Seems easy enough, right? Remember, however, the matching principle? The one that says you match expenses to the period when they help create the sale? The direct write-off method violates that principle, because the sale may have been made last year. Calling it an expense now won't match the expense to the time period when the sale was made. Another principle comes into play, materiality. Materiality says that it's a small amount, let's handle it the easy way. So if a company has very few bad debts, it can use the direct write-off method. But if it has a